What if I told you the world of finance is on the brink of its biggest shakeup in over a century? This isn't some far-off fantasy. It's happening right now, and 2026 is shaping up to be the year the fuse is truly lit. We're talking about decentralized finance, or DEFI. And you might think of it as a small, volatile corner of the crypto world, but the numbers tell a very different story. The DeFi market was valued at around $20.5 billion in 2024, but analysts predict it's set to rocket to over $231 billion by 2030. That's not just growth, it's a revolution in the making. This isn't just about crypto anymore, this is about rewriting the rules of money itself. It's about the collision of a brand new decentralized financial system with the old guard titans of banking. And today we're going to break down exactly how this historic convergence will unfold, why 2026 is the pivotal year, and which key trends and projects are set to lead this financial revolution. We're going deep, looking at the core problems this technology solves, the megatrends pushing it forward, and how you can position yourself for what's coming. This is more than a market update. This is a blueprint for the future of finance. Before we can really get the scale of the revolution heading our way, we have to be brutally honest about the system we have now. For decades, we've just accepted traditional finance, or TradFi, as the only way. We've accepted its rules, its fees, and its painfully slow pace. But in a world of instant information and global connection, this old system is really showing its age. Let's talk about something as simple as sending money to family in another country. You start the transfer and then you wait. It can take days for the money to arrive, bouncing between different banks, each one taking a slice of your money in hidden fees. The whole system is a black box. You send your money into the void and just hope it comes out the other side, mostly intact. This isn't a tech problem, it's an architecture problem. The system was designed before the internet, and it still runs on that ancient logic. Now think about getting a loan. If you need capital, whether you're a small business owner trying to grow or just an individual with an emergency, you have to go to a bank. You fill out mountains of paperwork, let them scrutinize your entire life, and then you wait for some centralized authority to decide if you're worthy. By its very design, this process locks people out. It excludes billions around the world who don't have access to traditional banking or can't meet the strict criteria these institutions demand. And what about creating wealth? For most people, investing means buying stocks through a broker. But when you buy a stock, you don't actually own it right away. The deal goes into a settlement period, usually taking 2 business days, called T+2. During that time, your money and your shares are in limbo, held by a huge network of middlemen like clearinghouses and custodians. This system creates friction, risk, and cost. Every one of those middlemen needs to get paid, and that cost gets passed down to you, the investor. The real problem with traditional finance is that everything relies on middlemen. Every transaction needs a bank, a payment processor, or a broker to check and approve it. This creates bottlenecks, jacks up costs, and puts all the power in the hands of a few giant institutions. It's a system that is inefficient by design, secretive in its operations, and exclusive in who it serves. It's a system built for the 20th century, and it's struggling to keep up with the 21st. This is the fundamental problem DeFi was born to solve. It's not just about a new kind of money, it's about rebuilding the financial plumbing to be more open, efficient, and available to everyone. The cracks in the old system are getting wider, and the demand for something better has never been louder. That's the stage where the DeFi revolution is about to take over. So, if TradFi is the problem, what's the solution? The answer is decentralized finance, and in 2026, it's not just some niche experiment anymore, it's going mainstream. At its heart, DeFi uses blockchain technology and smart contracts to completely reimagine financial services. Think of a smart contract like a digital vending machine. You put something in, money, and it's programmed to automatically spit something out, a product or service, without needing a cashier or anyone in the middle. Now imagine applying that same logic to everything from lending and borrowing to trading and insurance. Instead of a bank deciding who gets a loan, you have a lending protocol where anyone can provide funds and anyone can borrow against collateral, with all the rules written in transparent code. Instead of a stock exchange with brokers, you have a decentralized exchange, DEX, where people trade directly with each other from their own digital wallets. This is the power of DeFi. It replaces powerful middlemen with verifiable code. For years, the story was DeFi versus the banks. It was pitched as a battle between the old guard and the new innovators. But the story for 2026 is so much more interesting. It's not about replacement anymore. It's about integration. Traditional financial institutions aren't fighting DeFi now. They're actively figuring out how to use it. We're at the very beginning of a great convergence. Banks, asset managers, and other Wall Street giants are realizing the incredible potential for efficiency that DeFi brings to the table. They're building their own private blockchains, experimenting with tokenized assets, and looking to tap into the massive liquidity of DeFi protocols. And this changes everything. When a giant of traditional finance uses a blockchain system to settle trades, they're giving a massive stamp of approval to the core technology of DeFi. They're telling the market that this is no longer a fringe movement, but the next evolution of finance. This integration is creating a hybrid model, mixing the reliability and scale of traditional finance with the transparency and efficiency of DeFi. Imagine a world where your bank account can seamlessly connect to a DeFi lending protocol to earn you a much higher interest rate on your savings than any bank could ever offer. Imagine getting a mortgage not from one bank, but from a global pool of lenders, settled in minutes, not weeks. This is the future that the convergence of TradFi and DeFi promises. The total value locked TVL in DeFi, a key metric showing the assets being used in these protocols, hit $123.6 billion in 2025, a 41% increase year over year. This growth isn't just driven by speculation, but by the maturation of real institutional infrastructure. So as we head into 2026, the question is no longer if DeFi will be adopted by the mainstream, but how and how fast. The walls between the old and new financial worlds are crumbling down, and what's emerging is a single unified system that promises to be more powerful and accessible than anything we've ever seen. The revolution won't be televised. It will be coded, tokenized, and integrated into the fabric of our financial lives. This convergence of old and new finance isn't just a theory. It's being fueled by powerful real-world trends that are all set to hit a critical point in 2026. These aren't just small tweaks. They are seismic shifts that will unlock trillions of dollars in value and completely change how we interact with assets. Let's break down the three megatrends lighting the fuse for DeFi's explosive growth. Trend 1, the great convergence and the tokenization of everything. This is the single biggest catalyst on the horizon, the tokenization of real-world assets, or RWAs. Simply put, tokenization means creating a digital version of a real-world asset on a blockchain. This could be anything: a share of stock, a government bond, a piece of commercial real estate, a bar of gold, you name it. Why is this so revolutionary? Because it takes slow, clunky assets from the physical world and transforms them into liquid, programmable assets in the digital world. Think about a $100 million office building. In the old world, selling it is a slow, expensive nightmare of lawyers, brokers, and months of paperwork. It's an all or nothing deal. But what if you could tokenize that building into 100 million digital tokens on a blockchain? Suddenly, you could sell a fraction of it, a single square foot if you wanted, to anyone, anywhere in the world in seconds. This fractional ownership opens up access to asset classes that used to be reserved only for the super rich. This isn't science fiction, it's already happening. Financial behemoths are moving fast. BlackRock, the world's largest asset manager, launched its BUIDL fund, a tokenized money market fund on the Ethereum blockchain that attracted hundreds of millions in assets almost overnight. This is a huge signal of institutional appetite for on-chain tokenized versions of traditional financial products. The market potential is almost too big to wrap your head around. Projections for the tokenized asset market are staggering. Boston Consulting Group predicts the market could reach $16 trillion by 2030, while other forecasts range from $4 trillion to over $9 trillion. We're not just talking about creating new crypto assets. We're talking about moving the world's existing wealth onto blockchain rails. This is the institutional wave that will redefine DeFi in 2026. Trend 2, the rise of real-world yield and AI-powered security. For years, DeFi yield was often just a code word for risky returns based on printing more tokens. That's changing fast. The next evolution, powered by the tokenization of RWAs, is the rise of real-world yield. This means DeFi protocols will start offering returns that are backed by tangible off-chain economic activity. Imagine earning interest on your stablecoins that's generated from the rental income of a portfolio of tokenized buildings or from the interest paid on a pool of tokenized corporate loans. This is the kind of stable, predictable return that big institutions like pension funds are desperate for. It transforms DeFi from a high-risk casino into a legitimate alternative to traditional fixed-income markets. But with this new, complex financial system come new, complex risks. How do you manage a lending protocol that uses both volatile crypto and tokenized real estate as collateral? How do you stop hacks when billions of dollars in real value are on the line? The answer is artificial intelligence. AI is becoming the must-have security and risk management layer for this next generation of DeFi. AI-driven tools are moving from theory to reality with capabilities that humans just can't replicate. Machine learning algorithms can now watch on-chain activity in real time, spotting suspicious transaction patterns that could signal market manipulation or an incoming hack. AI can perform sophisticated credit risk analysis for lending platforms, looking at a borrower's on-chain history to dynamically adjust their collateral needs. It can stress test protocols by simulating extreme market crashes and even audit smart contract code to find vulnerabilities before they're exploited. This integration of AI doesn't just make DeFi safer, it makes it smarter and more resilient, giving cautious institutional money the confidence it needs to finally enter the arena. Trend 3, the scalability breakthrough and the L2 economy. The biggest thing holding DeFi back from onboarding the next billion users has always been scalability. The main Ethereum blockchain, while secure, can be slow and expensive. You can't build a global financial system if a single transaction costs $50. This is where Layer 2 solutions, or L2s, come in. Think of an L2 as an express lane built on top of the main Ethereum highway. They handle transactions much faster and cheaper, then bundle them up and settle them back on the main chain for security. By 2026, the L2 economy will be in full swing. We're already seeing an explosion of activity on L2 networks like Arbitrum, Optimism, and Base. In fact, L2s already process the majority of all transactions in the Ethereum ecosystem. Recent upgrades to Ethereum, like the Denkin upgrade, have slashed L2 transaction fees dramatically, making many actions nearly free. This makes all new applications like micropayments and high-frequency trading possible on the blockchain for the first time. And this isn't just an Ethereum story. We're also seeing the rapid growth of Layer 2 solutions for Bitcoin. These projects are starting to unlock the hundreds of billions of dollars of capital sitting dormant on the Bitcoin network, with some estimating that over $47 billion worth of BTC could be bridged to L2s by 2030, allowing it to be used in DeFi applications. The maturation of the L2 economy is the final piece of the puzzle. It provides the cheap, fast, and user-friendly experience needed for DeFi to compete with traditional payment systems like Visa and MasterCard on a global scale. It's the tech breakthrough that makes the dream of a mainstream decentralized financial system a reality. With these powerful trends as our foundation, the merge with TradFi, the rise of real-world yield, and the explosion of L2s, a new class of blue-chip projects is emerging. These aren't just speculative tokens. They are the core infrastructure that will power the next generation of finance. Let's look at the key players poised to dominate the 2026 landscape. Bitcoin, BTC, the institutional reserve asset. First the king, Bitcoin. For years, Bitcoin was seen as a purely speculative asset, but that story has completely changed. With the launch of spot Bitcoin ETFs, Bitcoin has been legitimized as an institutional-grade asset. We're seeing steady inflows from asset managers and even corporate treasuries looking for a digital store of value. Looking toward 2026, this trend is only going to accelerate. Many analysts now believe that Bitcoin's old volatile 4-year cycle is becoming a thing of the past. In its place, we're seeing a more mature asset with growth driven by steady institutional buying rather than retail hype. This increased stability will make it even more attractive as a core holding in diversified portfolios. Price predictions are always speculative, but they reflect this growing institutional confidence. Based on strong ETF inflows and a supportive policy environment, many analysts have a base case for Bitcoin reaching a range of $180,000 to $220,000 by the end of 2026. Some forecasts are even more bullish. The key takeaway isn't the specific number, but the why. Bitcoin is graduating from a niche crypto asset to a global macro asset, the digital gold of the 21st century, Ethereum, ETH, the global settlement layer. If Bitcoin is digital gold, Ethereum is the decentralized world computer. It's the foundational layer for the vast majority of DeFi, NFTs, and tokenized assets. Its importance can't be overstated. 3 key factors are driving Ethereum's dominance into 2026. First, its tokenomics. Since the merge moved Ethereum to proof of stake, the creation of new ETH has plummeted. Combined with a mechanism that burns a portion of transaction fees, ETH is often deflationary, meaning more coins are destroyed than created. This scarcity is a powerful value driver. Second is the explosive growth of its Layer 2 ecosystem, which we just talked about. L2s are scaling Ethereum to handle global demand while also increasing the transaction volume and fees burned on the main chain. Ethereum now commands a massive 63% share of all DeFi liquidity, a testament to its powerful network effects. Third, and maybe most important, is its role in RWA tokenization. When BlackRock decided to tokenize a fund, they built it on Ethereum. That's a monumental vote of confidence that establishes Ethereum as the preferred platform for institutions bringing real-world assets on-chain. Looking at price targets for 2026, analysts see a wide range. Some projections place ETH between $7,000 and $9,000, depending on ETF inflows and continued institutional adoption. Others are even more optimistic, with some models suggesting a path towards $17,000. Solana, SOL, the high-performance challenger. While Ethereum is dominant, its speed can still be a bottleneck for some applications. That's where Solana comes in. Solana was built from the ground up for pure speed, capable of handling thousands of transactions per second for a fraction of a penny. This makes Solana the perfect platform for things that need instant settlement and super low costs, like consumer payment apps, high-frequency trading, or decentralized social media. Major upgrades on the horizon, like Alpenglow, promise to make the network even faster and more efficient. Its active community of builders continues to push the limits of what's possible on-chain, and in some recent periods, trading volume on Solana's decentralized exchanges has even surpassed Ethereum's. The key to Solana's success in 2026 will be its ability to keep attracting developers and capture a big slice of the growing DeFi market. It has proven its resilience and is seen as one of the few real contenders to Ethereum in certain sectors. Price predictions are varied, but a strong bull case could see the token targeting its previous highs and beyond, especially with the potential for a spot Solana ETF on the horizon. The plumbing projects, Chainlink, Aave, and MakerDAO. Beyond the big blockchains, there's a critical group of projects that provide the essential plumbing for the whole DeFi ecosystem. Chainlink, L-I-N-K, is maybe the most important of all. Think of it as the ultimate translator. Its job is to securely bring real-world data like stock prices or interest rates onto the blockchain so smart contracts can use it. This is absolutely critical for tokenizing real-world assets. For a DeFi protocol to accept a tokenized building as collateral, it needs a trustworthy way to know the current market value of that building. Chainlink provides that bridge connecting the on-chain and off-chain worlds. AAVE, AAVE, and MakerDAO, MKR, are the blue-chip applications of DeFi. AAVE is one of the largest and most trusted lending and borrowing protocols. It's been at the forefront of innovation, and as institutional money flows in, proven platforms like Aave will be the primary destination. MakerDAO is the protocol behind DAI, one of the original and most resilient decentralized stablecoins. Stablecoins are the lifeblood of DeFi, and Maker pioneered using a diverse range of collateral, including RWAs, to back its stablecoin. It's a model for how to build a decentralized, censorship-resistant dollar for the digital age. These aren't just altcoins, they are fundamental pieces of infrastructure that are becoming deeply embedded in both the crypto economy and increasingly the traditional financial system. If you're getting value from this deep dive and want to stay ahead of the curve, do me a favor and hit that subscribe button. We're committed to breaking down these complex topics and giving you the clear, data-driven analysis you need to navigate the future of finance. And don't forget to ring that notification bell so you don't miss what's next. All right, let's get real for a minute. It would be crazy to talk about all this potential without also talking about the risks. The path to 2026 is not a straight line, and there are major challenges that could slow down or even derail this revolution. First up is macroeconomic volatility. The crypto market doesn't exist in a vacuum. A global recession, sudden changes in interest rates, or geopolitical conflicts can have a huge impact on investor confidence. In a risk-off environment where people are scared, even the most promising projects can see their value tank as investors run for safety. The second major wildcard is regulation. This is probably the biggest and most unpredictable risk. Governments all over the world are still trying to figure out how to handle DeFi. While some places are creating clear, supportive rules, others could impose strict regulations that crush innovation. A sudden crackdown in a major market like the US or Europe could send shockwaves through the entire space. Third is the ever-present threat of technological risk. While security is getting better, DeFi is still the Wild West in many ways. Smart contract bugs, protocol hacks, and governance failures are a constant danger. Billions of dollars have been lost to hacks, and every major incident damages trust in the ecosystem. As more value gets locked into DeFi, these protocols become even bigger targets for sophisticated attackers. Finally, there are market structure risks. The space is becoming incredibly fragmented with a dizzying number of layer 1s and layer 2s all competing for attention and money. This can be confusing for new users and can lead to capital being spread too thin. And of course, there's always the risk of speculative bubbles where hype inflates prices far beyond reality, leading to painful but inevitable corrections. Building a new financial system is an incredibly ambitious goal. It requires not just new tech, but also navigating a complex web of economic and political challenges. The vision for DeFi in 2026 is bright, but getting there will require a relentless focus on security, a smart approach to regulation, and a healthy dose of realism about the road ahead. We've covered a lot of ground. We've seen how the slow, closed-off world of traditional finance has set the stage for massive disruption. We've explored how DeFi offers a solution, a system that's more open, transparent, and efficient, all built on the power of the blockchain. We've identified the 3 seismic megatrends that are all converging to trigger DeFi's breakout in 2026. The tokenization of trillions of dollars in real-world assets, the shift to stable yield backed by AI security, and the scalability breakthrough from the Layer 2 economy. And we've highlighted the key players, from giants like Bitcoin and Ethereum to the essential plumbing projects like Chainlink and Aave that are positioned to lead the way. The picture is clear. We are at a pivotal moment in financial history. The era of DeFi being a fringe experiment is over. The era of institutional adoption and mainstream integration has begun. What's happening isn't just a small change, it's a fundamental upgrade to the operating system of money. And this convergence won't be simple or easy. It will be full of risks, from regulatory battles to economic shocks. But the direction of travel is undeniable. The promise of a financial system that's more inclusive and efficient is simply too powerful to ignore. The financial world is on the brink of a monumental shift. The question is no longer if this change will happen, but how it will reshape our world. The real question for you is, will you be a spectator or will you be a participant? Thanks for joining me on this deep dive. If you found this analysis helpful, please hit that like button and subscribe for more. And now I want to hear from you. What DeFi trend are you most excited about for 2026? What projects are on your radar? Let me know in the comments below.